What do you do when a bunch of frantic financial funds start bidding up spot uranium prices? If you are Cameco, you ignore them completely and borrow the nuclear fuel right out of your own basement.
It is, yeah. The ultimate house always wins flex.
It really is. Welcome to Earnings Unscripted. It is May 5th, 2026, and today we are unpacking Cameco's first quarter. Ticker is CCJ, and honestly, looking at these numbers, the actual physical business of mining uranium feels almost secondary to their supply chain acrobatics.
Well, the headline numbers definitely gave people whiplash today. You have top-line revenue coming in at $845 million. That is down 30% from the massive fourth quarter they just had. Diluted earnings fell to 30 cents a share, down from 46. But then you look at gross profit, and it actually grew. Margins rocketed from under 23% to almost 36%.
Which makes zero sense until you see exactly how they did it. And quick side note before we take this engine apart, everything we say here is just our personal opinion, so please do not take our banter as financial advice. Anyway, Miro, the market clearly did not know how to price this paradox today.
Oh, completely confused. The stock gapped up nicely pre-market, sitting around 122 at the open. But then, once regular trading started, it just steadily faded the entire day. Ended up closing with a net negative reaction of about 2%.
Right, which feels like an overreaction, but I guess that cash flow number was pretty jarring.
Yeah, I think people saw the cash flow line and just hit sell. Operating cash flow swung from a huge positive last quarter, nearly $700 million, to a negative $22 million outflow. Management says it's just seasonal tax payments and working capital timing, but it still hurts to look at it.
It does. But getting back to that margin spike, this is genuinely my favorite anecdote from the quarter. So spot prices are flying high. Most utilities would be absolutely sweating trying to feed their delivery contracts.
Because they would be forced to buy at a huge premium, exactly.
Right. But Cameco runs these massive refining and conversion hubs in Canada. Other clients literally just park material there. So Cameco quietly opened up these product loan facilities and borrowed 750,000 pounds of uranium from their own internal storage network.
Completely sidestepping the spot market mania. It's a brilliant arbitrage. They drove their unit cost of sales down to $58.13 a pound. 58.13, down from over 70 last quarter. You simply cannot do that if you're just a pure play miner digging rocks. It proves their infrastructure is actually a heavy financial moat.
Totally. And beyond the mining, there's this massive geopolitical storyline brewing with their Westinghouse reactor segment. Apparently, the U.S. government is quietly organizing a global build-out and basically taking a cut.
Yeah, the patriotic capitalism angle. It changes the entire valuation model.
All right, let's get into the details.
The details are exactly where this gets wild. I mean, we need to talk about this Westinghouse deal with the Department of Commerce. It is not just, your standard policy push. The U.S. government is literally structuring an equity upside for themselves.
Wait, equity? I thought they were just fast-tracking the permits or throwing some subsidies at the new builds.
No, that is the thing. Grant Isaac actually used this phrase. He called it patriotic capitalism on the call. He said, let me just find the exact quote here. Right, he said it is, quote, this notion of patriotic capitalism, which the current U.S. administration has been pursuing, which is the idea that if they do something extraordinary to support targeted strategic businesses, that the U.S. taxpayer has a right to participate.
Wow. Okay, that is a very, very polite way of saying the government wants a cut of the action.
A massive cut, yeah. They essentially negotiated a toll for helping assemble this $80 billion pipeline. The U.S. wants to build like 10 plus AP1000 reactors. And if Westinghouse hits a $30 billion valuation event down the line, the government gets up to a 20% participation interest in distributions over $17.5 billion.
Which translates to what exactly?
Roughly an 8% ownership stake, just for helping organize the order book.
That is almost like a mafia protection fee.
Yeah.
But completely legal and wrapped in an American flag.
Right. It is state capitalism, but honestly, from a shareholder perspective, it's brilliant because you're tying the government's financial success directly to your reactor deployments. Isaac mentioned the U.S. is in this, he called it an electron supercycle, and the administration is now highly incentivized to make sure these plants actually get built.
because the taxpayer makes money if Westinghouse wins. That is actually fascinating. It basically underwrites their entire political risk.
Precisely. But here's the thing. While everyone is staring at that Westinghouse narrative, they are completely mispricing the core uranium business. This was probably my favorite technical catch from the entire quarter.
Oh, you mean the contract pricing? Because I noticed they only realized about $66 a pound this quarter, which, it seems fine, but not amazing.
It seems fine, sure, but look at the industry benchmarks. All the financial networks keep quoting long-term uranium prices right around $91.50.
Right, which sounds great compared to where the market was 3 years ago.
It sounds great, except it is basically an illusion. Isaac pointed out that this $91.50 price only reflects the 30% of contracts that are built on base escalation.
Wait, so it completely ignores the other 70%?
Exactly. The other 70% are market-related contracts, and those have floors in the 70s, but the ceilings are structured way higher. Buyers are literally preparing for ceilings over $150 a pound.
Jeez. Over 150?
Yeah, so the true structural midpoint of that huge 70% block is not anywhere near 90. It is sitting comfortably around $115 to $120. The upside is massive, but the standard reporting just cannot model it properly, so they just ignore it entirely.
That is exactly why this sector drives people crazy. The actual physical market is doing one thing, but the publicly reported benchmark is telling a completely different story.
Yes, exactly. It is a hidden compounding engine. The ceiling protections are drifting up, and almost no one is pricing that reality into their long-term models.
Okay, so if you combine that stealth pricing power with the whole government partnership on the reactor side, the underlying foundation actually looks incredibly strong. But obviously there are some operational cracks if you look at their actual cash flows right now. So where does this leave their risk profile heading into the rest of the year?
Well, I think you have to look right at their guidance. They reiterated everything for the full year. They are still targeting that 19.5 to 21.5 million pounds of uranium production. That Q1 cash bleed, it is really just working capital timing. But if we are talking actual structural risk, I'm staring straight at Kazakhstan.
Right, because of the new tax laws they just implemented.
Exactly. As of January, the mineral extraction tax on their Inkai joint venture is no longer a flat 9%. It scales up to an 18% base plus a spot market penalty. That is a permanent change to their cost structure over there.
Which honestly makes that independent Western supplier angle they're pitching so much more important. But looking at the rest of the year, Tim Gietzel straight up warned investors on the call. He said to expect, quote, some lumpiness in Westinghouse's quarterly results. And I feel like we talked about lumpiness on the last episode, too.
Yeah, lumpiness is basically their corporate motto now. Westinghouse posted a net loss this quarter, mostly from acquisition amortization. Management says the real cash generation is heavily skewed toward the fourth quarter. You kind of just have to close your eyes and wait until December.
So you're saying the big picture is pristine, but the day-to-day plumbing is a bit chaotic?
That is construction math for you. If you want the geopolitical nuclear boom, you have to survive the quarter-to-quarter volatility.
Okay, I think that is our cue to wrap up. We'll see if those lumps smooth out in a few months. Thanks for listening, everyone. We'll catch you next time.
See you then.
Just as a quick aside, if you want these earnings breakdowns to automatically show up for you, it is probably easiest to just follow the podcast. And for full transparency, an AI actually pulled the raw data and quotes straight from the SEC filings to help us generate this conversation today. We would love to know what specific tickers you want us to dig into next. So just drop an email to earningsunscripted@datamadness.ca, or you can find our X link right in the show notes.
Talk soon.